Greg Andrick here, bringing you another Business Freedom Conversation post. So, as we've long expected, mortgage rates are continuing to increase. The Fed has increased the rates. They haven't for a little while, but all this takes time to get effect. And now we're seeing 8% in mortgage rates appear. The average 30-year mortgage rate is 7.57, but it's heading to 8% because that's what the new rates are as of yesterday. I have a video here. It's a CBS News story, and I think it'll help you kind of figure out what's going on in your business. One of the key things I would say is there is a general unhappiness surfacing because people are stuck. I mean, when you have more than 60% of the country has a below 4% interest rate, so people are looking at their mortgages, the payment doubling or tripling. I mean, if you've got a 2% mortgage like it was for about 6 months a couple of years ago, you're looking at a mortgage that's going to be 3 or 4 times higher than the one you have now, which means you can't move, you can't change your job, you can't do all kinds of things. And then people that have to because they've been laid off, look at all the big companies that are laying off, they're stuck because where they go, they may not be able to afford a house, but then again, you have all these really high rents. So it's a tough situation, and this story is to help you figure out how to cope with your employees, your customers, and your vendors, because they're the ones that are under all this pressure. And it'll be interesting to see what the Fed does. They're holding now, but this has been their long-term objective, to inflict pain on the consumer to slow down the economy so that inflation comes down. And I don't know about you, I have a post a couple days ago about the real inflation rate. The post office has raised their postage in the last year 13.3%. I just got my State Farm insurance policy on my car. Guess what? It's up 15%. So I don't think the real inflation rate is that 3.7%. And remember, for the Fed to control inflation using interest rates, that interest rate has to be over the inflation rate. And if the real inflation rate is 13, 15, 18%, what are they going to do? Remember 1981, prime interest rate to corporations, that means the best borrowers, was 22% because inflation was around 19 or 20%. And another thing to remember, what this story is kind of a harbinger of, is that all of the methods that the Fed uses to make these interest rate increases, the Bureau of Labor Statistics and the different agencies in the government, these data collection methods were developed in the late 40s, early 50s, and they're manual, and they take up, some of the segments take up to a year to get into the numbers that the Fed is seeing, which is why they're going to continue to have persistently high inflation. It's really, they're not looking at the real numbers. The real numbers are going to get modified as the numbers come through this antiquated collection system. So information for food of thought, how to direct your business, how to deal with your customers, employees, and vendors. This is Greg Andrick, Business Freedom Conversation Post. I'll catch you on the next one.
For prospective home buyers, even as housing prices remain high, mortgages continue to go up as well.
That's right. The average for a 30-year fixed-rate mortgage rose to 7.57%. That's according to a Freddie Mac report. It's up from 7.49% from last week, bringing it to its highest level since 2000.
For more on this, we are joined by Axios chief financial correspondent, Felix Salmon. Felix, tell us, what's the impact on everyday Americans and the overall economy when mortgage rates get this high?
So for most people buying a house, it's not huge. It just means you're not likely to buy a house because mortgage rates are so expensive. For the overall economy, because people aren't buying houses, what that means is we get less activity in things like furnishing and construction and renovation and all of those kind of industries. One really big effect is that the people don't move, right? If you get a job, or you might want to move for a job or to improve your life or to get a bigger house or to downsize, all of those things just become incredibly unattractive. Most Americans who own their home have a mortgage rate of less than 4%. And so even if you buy somewhere smaller and cheaper, your mortgage might well go up in price if you move. So what that is doing is it's keeping people stuck in their homes in places that they don't like and don't particularly want to live anymore. And so there is this kind of broad unhappiness that is spreading across the country the longer this goes on.
What's so interesting is I remember when 7% was an all-time low.
Right, that was a good
That's
rate.
how far back I go. So for folks who want to buy a new home during this time, what's the right move here?
Well, the good news is that U.S. mortgages are prepayable, right? So if you get a mortgage rate which is very high, and then eventually mortgage rates come down, you will be able to refinance and get a cheaper mortgage that way. The other move is just get an adjustable rate mortgage, right? Adjustable rates are much lower than 30-year rates, or significantly lower. They often have like 5 or 6 handles. And so that's a good way of saving money as well.
All right. Felix Salmon, thank you.
Thank you.
Taiwan Semiconductor, they